Joining us now, Sam Stovall, CFRA Research Chief Investment Strategist. You date the bull. You think it's October of 2022. So you think the 3-year, or is it before that, Sam? So we're embarking on the third year now, is what you're saying, and that could mean some volatility. We call it volatility when it doesn't go straight up. Although I guess it could be. If it went up every day a lot, that could be volatility. But you mean maybe not completely smooth sailing in the third year.
That's right. Good morning, Joe. Well, we have had 11 bull markets that celebrated their second birthday. We did that just recently on October 12th. And of those 11, 3 of them fell into new bear markets within the coming 12 months. 2 more posted declines in that 12-month period. And then 3 additional ones posted gains of that were below average, anywhere from 2 to 6%. So leaving only 3 of the 11 to post returns that were worth writing home about. So basically what I'm saying is investors should not assume that we're going to see another 34% gain in the third year that we did in the second year, which, by the way, was the best of all second-year bull markets since World War II.
It's been hard to find actual coincident events every day to be good for another new high, which is what we've been seeing. We've even had some days where it seemed like the news was not great, whether it's inflation or the economy running too hot, and the market still seems to almost be like a beach ball. It just doesn't go down. It keeps going up. And then people are saying that's because of $6 trillion that are on the sidelines. Is there a lot of liquidity still?
Sure, there's a lot of liquidity. There is also very broad participation. I think with the advent of the Fed now starting a new rate easing cycle, with traditionally the last 2 months of an election year being positive with all sizes, styles, sectors, and 97% of the sub-industries in positive territory. And then also knowing that if you have an up September, we typically have an up October in an election year. I think investors are basically saying, I don't want to be behind the market again this year as I was last year, and are therefore putting the pedal to the metal.
On any of those previous 11 2-year bull markets you looked at, were there ever significantly higher new highs made before it didn't either moderated or came back down? I mean, is it possible this goes on for another 6 months before you see a bumpiness?
I think that certainly is a possibility. Certainly all of the 11 bull markets that celebrated a second birthday experienced declines of 5% or more in that third year. So nobody escaped volatility that caused investors to wonder whether the end was near. But I think from a seasonal perspective, the end of this year tends to be fairly strong. First year of presidential cycles, the market was up about a little more than 9%, so slightly better than the long-term average for the market as a whole. And traditionally, we find that the market does take a bit of a breather in the first quarter and then picks up steam again in the second quarter before stumbling in the third. So essentially, I think that unless we get to a point where people start to question the Fed, question growth in the economy, or we have a geopolitical event that upends things, I think it seems as if there's smooth sailing for the next 3 to 6 months.
Yes, a lot of things that we never know what we don't know. But in terms of the Middle East oil prices, the 10-year has been stubbornly sort of moving higher, even though we're told we're going to have 125 or 150 basis points of cuts, and yet would you ever see the bond market feeling like the Fed has lost control of inflation, or do you think that inflation is going to go the way that the Fed is hoping?
Well, we think that inflation is going to go the way the Fed is hoping, but we're not going to see their magic number of 2% year-on-year growth in core CPI until 2026. But since the Fed is essentially aiming at a target that's below the horizon, whatever moves they make, they realize are not going to be felt for 12 to 18 months down the road. So I think they don't want to maintain a tight policy for too long and therefore cut off the soft landing or no landing outcome. But I think, yes, that the bond market, which really is not controlled by the Fed, is indicating that, there's reason to feel that maybe inflation won't be coming down as quickly because we're seeing stronger than expected GDP growth. Retail sales, which are expected to come out later this week, should remain firm. And we have a resilient employment picture.
Do you think if we didn't get gridlock, that would explain why we had not a great third year? If it was a sweep on either side, do you think that would explain why we had a subpar third year of a bull market?
Well, gridlock is good. We do know that the best performances have come out of those years in which we had a split Congress. Unfortunately, you have pretty few observations with that. The greatest number of observations is when you do end up either with a totally unified government, meaning either a blue or a red wave, or you have a unified Congress. So it looks as if, based on CFRA's Washington Analysis Political Strategy Group, that we are likely to see a split Congress once again.